So we are going to start the next session. It's a fireside chat with the CFPB director. And the moderator is Professor Richard Herring from the Wharton School. He is also on the organizing committee. And it would be interesting to let you know that Professor Herring has a lot of very good, successful students. The last time he was on the stage, he was interviewing one of his students, OCC controller. And this is the second time he's going to interview his most favorite student from the Wharton School.
Thank you, Jalapa, for that very kind introduction. And this is indeed a great pleasure for me because Rohit was one of my favorite students, and we were working together in the great financial crisis. So it's one of those things that is sort of seared in your memory. And frankly, one of the great pleasures of teaching at Wharton, and the reason I've been there for 51 years, is the opportunity to interact with students like Rohit that have great ideas, and occasionally they're really dedicated to public service, which was the wonderful thing about Rohit. Even then, you could tell. Rohit's had a meteoric career as a bureaucrat, sort of. I guess we'd say as a regulator. He was referred in the press as having a muscular approach, which I think in the context of the article wasn't really praised, but I think it does indicate that he's somebody who really takes his job seriously and does his homework and really intends to get things done. So we have this opportunity to talk with the head of the newest of the federal regulatory agencies. And when you talk about the whole digital asset realm, there are really 6 federal agencies on top of the myriad state agencies we've heard from. And of the 6, the CFPB is clearly the new kid on the regulatory block. It was a child of the Dodd-Frank Act in response to abuses that were perceived underlying the crisis. But it's also unusual in that the CFPB is not a charter-driven regulator. All of the others are. It depends on how you classify a digital asset. If we can agree it's a commodity, we sort of know what to do with it. If it's a security, we know what to do with it. If it's a bank deposit, we know what to do with it. If it's a collectible, maybe we do need new regulation, but I don't think people are seriously opposing that idea. But Rohit's charge is to protect consumers, protect consumer retail products. As his colleague noted yesterday, it is a technology neutral mandate. And so I guess I'd like to begin by asking Rohit how he approaches the job when you have basically an entire domain of institutions to worry about.
Yeah, well, I think one of the important reforms after the financial crisis was actually to get around some of this charter nonsense, the regulatory arbitrage, and really putting in place a supervisory system over banks and non-banks that was a little bit more level. And I think when it comes to emerging technologies, of course, that is going to come often outside of the traditional chartered banking system. And so we have an especially important role in making sure that any sort of risks do not actually transmit not only to harm consumers, but also to the entire financial system.
So you view yourselves as having a financial stability interest as well?
Well, I mean, if there's one lesson from the last financial crisis that I hope we learned is that widespread abuses of consumers have something to do with the financial system and its stability. There's no question that the failure for the regulators to appropriately watchdog the mortgage market had absolutely catastrophic consequences. And in fairness, those regulators had consumer issues near the bottom of the list. Yeah. So I think this gives us a sense of real focus. And with respect to where we're seeing so much, changes and evolution in technology, of course, payments is really number one in focus for us. So a lot of folks are focused on really blockchain-based technologies, but really there is a lot of evolution of real-time payments in the U.S., we are actually farther behind other jurisdictions when it comes to real-time payments, but it raises a whole host of issues that implicate a lot of financial regulatory domains.
Now, how far do you search for these kinds of issues? Because you can find payments like things in anything from Venmo and Zelle to what's basically happening in a number of technology companies that are facilitating payments. They're not quite members of the payment system, but how do you monitor to know where you really should focus attention?
Well, I think if you look at where there has been a lot of attention on cryptocurrencies and stablecoin, that's really primarily being used for speculative trading purposes. Even stablecoins are really used by traders to go in and out of cryptocurrencies. But I was a federal trade commissioner before this job, and I think was very involved in the global discussions when Facebook had its Libra fiasco. And it was a wake-up call, I think, to the financial regulators, the privacy regulators, a whole host of government agencies, and of course, central banks. And the idea of a very big platform, like a big tech giant, having the ability to mint its own currency, and this is not like a Disney dollar. I mean, this is something that could be used by merchants and real commercial activity all across the globe and scale very, very quickly. Now, fortunately, that project did not really turn into reality, but I am worried about, are we prepared for very rapid consumer adoption of new payments instruments? We have ordered Google, Facebook, Amazon, others to really share with us what their plans are for any sort of payment systems that they're deploying. And I think that the real challenge we're facing is the integration of payments and commerce is getting very, very blurry right now.
Yes.
And there's a lot of implications for merchants, for consumers, and for the financial institutions themselves.
Well, and China has shown us, in a way, the power of that model. If you look at Ant or Tencent, they had a remarkable hold, starting from basically understanding transactions. I think in the case of Ant, it was facilitating transactions by enabling that threshold issue of enabling a seller to trust a buyer. But the byproduct of that was accumulating an enormous amount of data that enabled it to enter lending, to basically accept deposits and money market funds, grew into securities, insurance, and had an enormous sway over retail as well. Now,
and we are lurching into that system here. I think if we just are, sitting and watching, we will shift toward that. And I think that is not something I'm quite skeptical about whether that type of market structure is good for the entire ecosystem. I'll say this: WeChat Pay and Alipay really have the enormous visibility into almost every single aspect, in some cases, of someone's life, combining geolocation, messaging, their social map. They're actually able to create social scores that can be used for a wide array of purposes. And I think for me, we are going to be implementing some rules that give consumers more control over their data and have greater personal financial data rights. I think the more we can keep that in the consumer's control and really be able to protect data privacy, protect security, and also use it to foster a lot of market entry. You could see startups, small financial institutions lower their customer acquisition costs if they have access to someone's transaction data or deposit account history. I think where I'm a little bit more wary is that if it all gets dominated by, a WeChat or Alibaba-like platform.
Well, there do seem to be some natural tendencies toward not huge economies of scale or network economies that make the system very, very concentrated in a few players, sometimes even one. And you're really fighting a difficult battle in the U.S. in a way with the fact that U.S. citizens are very blasé about the value of their financial data. In order to get free services, you don't tell people at Facebook almost anything. And a number of people seem to be happy enough with the bargain, although I don't think they've thought it through. In my own personal life, I'm not really into Facebook at all, but I am intrigued by the financial aggregators who can let me put together all the bits and pieces of my financial life. And if I had the courage, I could mark myself to market every day. I don't, but I could. And I was sort of willing to give up that degree of privacy because it gives me the feeling of much more control and power. It adds value, but I don't really know what would happen if there were a data leak in one place or the other. And that's something I know you've thought a lot about, which is.
Yeah, I would say this. It is true that, for example, if you look at German citizens, if you look at other jurisdictions, especially those that were more shaped by political volatility around wars, and they have different views and feelings about protection of data. I think in the U.S., I would characterize it a little bit as powerlessness about what can I really do? They're going to get me in one way or another. And so, that we should put that aside because I think that has to be solved across sectors, whether it's your education data, health data, whatever it may be. But with respect to payments data, typically your payment transactions were something really known by your bank. And because of the history of separation of banking and commerce, and banks typically don't use and resell, they don't monetize that data outside of financial products. And so once you start using payments data, in personalized pricing, perhaps to use it against your competitors, if you're competing with a service, and there is no question, there is a race for the digital wallet. You see tech companies, you see financial institutions, they want to know what payments data is moving through the system. It is a really challenging problem right now. And one of the things the CFPB has released today is what is some of the implications of this blurry line of you monetizing payments data, and how is it revealing itself through how buy now, pay later is evolving, how embedded commerce is evolving. So there are questions about could, like you said, there be such strong network effects that a couple of players, like we see in China, really control all the flow of data? And what can we do to make sure that they're not creating moats, and that we as individuals and consumers can take that data and actually permission it to others as well? We want to make sure, though, that we don't have a system where even if consumers are permissioning it, that those firms are not using it for nefarious purposes, or that they're not engaged in an underground kind of data brokerage world. But I think that's really where we are at this moment, and we have to nail this.
And I think the public at large is not aware of the value of this kind of data, which should be evident from the fact that a number of firms are basically providing services for access to that data alone. But it raises another piece of your domain that is quite interesting. You've had an Office of Innovation, I think, since the start of the CFPB, but you've recently retitled it to Competition and Innovation.
Yeah,
It raised eyebrows in a number of quarters, but it's really in your charter.
We did a very good look back at the Office of Innovation's work, and by almost every metric, it failed. It failed to actually promote innovation. It ended up picking winners and losers, where certain firms were actually advertising that they have gotten, an exclusive permission from the CFPB. So it was really just not working. So really what we're retooling it is to think, how do we not make it about picking one individual market participant, but trying to identify the obstacles for people to enter, and also what can be more broadly applicable so that lots of different entities can figure out how to offer new products. When you look at, for example, in the United Kingdom, they do not do this crowning of, one individual market participant who happens to be represented by a former employee. I mean, the opportunity for mischief is unbelievable, and we've ended all of that. And instead, we're going to be putting in place some new policies that are actually more participatory, are going to help a lot more entrants rather than just, one or two here and there who happen to be, well connected.
My reading of the history of the agency is that this is a very different departure. I mean, you really are concerned about competitiveness in the market for consumer
it's
financial
actually
services.
always, if you look at the
It was in the rule, I know.
Or if you look at the three core mandates of the CFPB, its market should be fair, transparent, and competitive.
Yeah.
And I think anyone who cares about consumer protection always gets worried when markets get too dominated by a handful of incumbents, because that actually what leads to less choice. It leads to more difficulties, obviously, to switch. So we do want a lot of entry, and we want it to be about really solving problems in people's financial lives rather than figuring out, how do I just create a moat around my business so that, no one can ever challenge me? And that's honestly what the equity markets want. They want durable businesses that are hard to switch out of. And I think from a policymaker's point of view, you always want big firms looking behind them to see who's coming after their customers.
Yeah, and APIs, I guess, have been the technology more than any other that have sort of changed the possibilities for switching and for broadening it.
Switching, by the way, is not easy in a lot of markets, and in many cases, in the consumer finance ecosystem, the consumer doesn't even choose. If you think about after origination of a loan, your mortgage servicer, the credit reporting agencies, debt collection, a lot of the ecosystem and infrastructure is chosen for you.
Right.
And so absent the ability to really switch, often the only way to get rid of a bad mortgage servicer is to refinance your mortgage. And then you may end up with the same servicer again.
I actually ended up paying mine off. I was so tired of being
So I
switched
think
around.
figuring out how can we give the ability for consumers to switch, we're thinking very hard about how is it that people can, switch, refinance their credit card debt, their auto loan debt, looking across markets. And we see a lot of very interesting firms trying to solve those problems, offer people products that are getting them lower rates, better service, rather than consumers feeling, locked in.
The last session, and in fact, I think a number of sessions yesterday, made the point that one of the reasons that consumers are so interested in switching out or looking at non-banks, looking at technology providers, looking at non-traditional providers of payment services is that they think the current system is too slow and too costly. And so there's, I think, a clear demand, although there was a little bit of dispute yesterday, that people would really like a real-time payment system that doesn't cost too much. The downside of that, of course, is if you don't have any friction in the system, everything's final when it happens. And if you have fraud or an error, it's very, very difficult to unwind it.
Right.
And you have to worry about both pieces of that.
That's right. And I think, there's payment, there's settlement.
Yeah.
It is true that in many cases there is a temporal gap, particularly when a very common way of electronic payment is a debit card transaction. There's authorization, there's a whole technical process. But I think we're seeing a number of real-time payment solutions, across the board. Of course, the Federal Reserve System is going to be deploying FedNow, which will be the first real 24/7, 365 real-time settlement service that every bank can participate in. There's also all sorts of private sector technologies. From the look of the regulator, I have now talked to most of my counterparts who have had major experiences overseas with shift to real-time payments, and the increase in fraud is really astounding. It disproportionately in the U.S. We can tell it's already impacting mostly older adults, including widows and widowers. We know that it's disproportionately affecting members in the military, others who've been subject to identity theft. So figuring out how do we, ensure we have a law in the U.S., the Electronic Fund Transfer Act. How do we make sure and think about, is this, how would it apply in a real-time payment system? Or is it simply just going to be treated like I give you cash and you run away?
Yeah. And the trade-off, I think, unfortunately, would have to be some sort of slowing down. So there is a safeguard in the process too.
Well, I don't know. We're looking at a lot of different options on this. I will say you're starting to see some firms make very minor changes to their user interface and user experience to really kind of curb some of this. In some cases, you might be asked, what is the last 4 digits of the phone number of the person you're trying to send it to? Creating the user experience that actually can cut down on a chunk of this. I think those types of solutions we're going to see more of.
Well, and I guess one of the motivating factors is who bears the cost when it doesn't work. And at this point, it seems to be bad publicity is the main cost.
Yeah, well, Congress made a determination in the context of several other bank-based payment instruments that liability was going to be capped for the consumer. The theory being that the bank and the banking system was really very well positioned to eliminate a lot of it. And it is true. I mean, the amount of fraud analytics that you see the payment networks and the banks do, many of you probably personally experience getting texts or alerts when there's a suspicious transaction. So there is ways in which looking at these broader data assets can help deter fraud. The Federal Reserve System, of course, at the Atlanta Fed has a payments, database and work that they do there. So I think it's going to require all of us among the regulators and the Federal Reserve System to really think about what our role is in this.
I think that's true. And I've seen personally the huge investments in AI and other ways of mining data to try to deter credit card fraud, which is a very big cost that if you can control, and was something that changed a lot when people went from signing at a place of work to being able to do it online. It leapt out by leaps and bounds. But it was something that banks were highly motivated to invest in, huge expenditures to try to get it right. And they've really made a lot of progress. But that was motivated because they had the liability. And so I think it's very important to figure out who bears the cost if something goes wrong, because it inevitably will. And that will be the
that will spur the investment or some of the behavior
to look at safeguards.
No, that's right. And I think I want to, the complexity and sophistication of certain types of identity theft and consumer fraud right now are really astounding. The ability, I think we've become normalized to the idea that phone numbers can be spoofed when they're calling our phones, that you don't really know who's calling. It can be very hard to authenticate. So we have a lot of work to do, including in our communications infrastructure in the U.S. to fix some of that.
I've been at the teaching game long enough to know that the old days when we used to post things by social security numbers.
Yeah.
Nobody thought of it as being a key to your whole personal life.
And I worry, though, that in some cases we want there to be strong security standards, but we don't want it only available from a handful of very large firms.
Yeah.
And I think that has been a lesson about how do you make sure we are getting a lot of the advantages of advanced computational methods and looking at big data sets, but who are the benefits accruing to? Are they accruing just to a handful of firms or really to the whole system?
Well, yeah, I think you can make an argument that consumers do benefit from that in the end, because the costs of providing the services do go down. But you're certainly right that there have to be gains to the people who are investing in it, or they're not going to.
Yeah, and also what barriers are created to new entrants if it becomes table stakes to simply have that degree of volume of data And if you can never really compete with that, what do you do?
Well, and I can't tell you the number of times I've been frustrated recently not being able to verify myself with 2 and 3-factor identification, and we have a government that is, I think, very, very averse to assigning identities, which is an advantage many European countries have, that there is at least a standard that you could rely on for IDs.
Yeah, I mean, I think if we were to design it from the beginning, we would not. Social security numbers were not designed to be unique identifiers. They were designed
Definitely
for,
not.
A social security system. So I don't know. I was pretty close to. I was at the Federal Trade Commission investigating the Equifax massive data breach at Equifax. I think part of the challenges of this is it is not simply kind of random hackers. These are state and non-state actors,
yes.
And there have been indictments of, particularly from China and Russia. So,
but we can't enforce them.
That's the challenge. And so, what do you do to generally make the system more resilient? And part of that is it's a technology game, but it's also figuring out, as you said, the right way to assign liabilities around data protection.
Yeah, it is a very, very tricky proposition. Now, when you begin to scan the environment for what you should worry about next, you have recently, I guess, focused on payment and commerce. I think there was a report that just hit the web today, which I had the advantage of being able to scan quickly, which is very interesting, but it's one step in what could result in rulemaking, as I understand it. Is that?
Well, we're going to soon be releasing a detailed study on buy now, pay later, which is also part of the broader payments and commerce debate. I think buy now, pay later has had explosive growth in the U.S. We have seen it play out in other jurisdictions, including Australia, continental Europe. I think for many consumers, this is a really it's a really attractive option compared to using a credit card. At the same time, lots of questions about how they're using that data. Is there regulatory arbitrage? What happens on basic things like when you return the item? So we're going to be publishing that study, laying out some next steps about where we might go. In terms of the core places that we think about a lot, obviously looking about the state of the consumer right now, we do see that generally the consumer is pretty strong. They still have, a decent amount of deposits that they have in their accounts. At the same time, they are paying much more on their auto loans. We're starting to see changes in the interest rate environment affect, credit card rates and indebtedness. I am looking hard about whether we're going to see a big uptick in home equity lines of credit. So there's a lot happening right now, and we're going to see a lot of technology firms and a lot of nascent firms really get in on that. And I think our core focus is making sure that there's a level playing field and everyone's playing by the same rules.
Interesting. Well, Rohit has very graciously agreed to take questions from the audience. And so in the last remaining minutes, we can do that. We will continue our conversation until we get a question, but I think there may be a number of people who would like to. Yes, please.
Oh, thanks. Director, how you doing? Thanks for being here. I spent the first several years of my career writing consumer regulations, Truth in Lending, RESPA, ECUA, and then enforcing those at the Control of the Currency, and I was in the Consumer Protection Division. And it occurred to me after all those years that the main problem we had was not enough regulations and not enough disclosures and not enough bureaucracies. The main problem was financial literacy in this country, which was pretty terrible. And it occurred to me that the best thing we can do is try to figure out how to help people help themselves by making them more financially literate. And I don't think we've done much in the 40 years since I was writing those regulations. I know the CFPB is focused on that. I know you've thought about it. Do you think we're making any traction in that regard to making financial literacy more important in helping people protect themselves?
Yeah, I think generally financial literacy has, the experiment has not had much success. A couple reasons. One, I think in some cases, financial education literacy has made people worse off because they become overconfident. The ability for someone to be able to, for in the public system to teach it, it is outweighed by enormous marketing advantages and behavioral targeting advantages of firms who are competing. So a few things we are doing. One, we're trying to change a little bit of how we're thinking about it to be more oriented toward reducing the shame, knowing how to spot risks, knowing where to go to unbiased information. So it is a long process. That being said, I think a lot of we never expect someone to, have a medical degree to be able to, have a good health. We want to be able to point them in the right direction and be able to spot issues and know when to ask questions. And the truth is there are many people who financial products are often very challenging to understand. And I agree, though, disclosures are not going to be what's fixing it. What is often going to fix it is to eradicate unlawful actors who really prey on people. And that was really the lesson, too, of the financial crisis, is a lot of regulators just sort of, sitting dumbfounded as, there is massive abuse going on with no real enforcement whatsoever.
One of my colleagues, Olivia Mitchell, has done some fairly fundamental research on financial literacy and has done it globally. And Americans turned out to be woefully unprepared for very basic reasons. They can't compound interest, for example. They're not so good at computing a rate of return is kind of beyond. So there are even deeper problems that I think have to be addressed.
There's been research to show that actually numeracy is more valuable than actually specific financial product education.
Yeah, I think that's
because
right.
it gives people the analytical skills to be able to really see what they're doing.
No, I agree, and it is a continuing problem. I wish that we had a crisp answer, but I think it goes back to public education and numeracy in the end. Although product simplicity, I think, is also really important, because if you layer service upon service, it's very hard to make comparisons. It's very hard to know what you're paying for which.
It is. I have
and
to
things get bundled in a way that sort of defy analysis.
It is. It's hard sometimes. I have classmates, some of you who know, will call me and say, should I get a 10-1 or a 30 or a 7? And I say, don't you trade mortgage-backed securities? I think the idea of being able to figure out where you think rates will be, how long you're going to stay. Some people don't even know the questions to ask, and I don't know if they can always figure out where is the unbiased advice to go to.
Yeah, I think that's sure. Please go ahead.
Thank you. Director Chopra, thank you for taking our questions today. Really appreciate it. My name is Armin Meyer at Lending Club. Really appreciate the new focus on competition. I think the market really wants to be able to compete and not have market failures get in the way. I think many of us would agree that is good for consumers and good for the industry. Wondering how you see some of the market failures from your perch and how the CFPB would address them versus, say, the DOJ or an FTC. Obviously, transparency is one of the three pillars you mentioned in the CFPB. That's a classic one for asymmetric information. We said a lot in small business lending space and are doing our best to ensure that as market participants. But there's obviously others. So like optimization or externalities.
So one of the things actually that the has been interesting recently, the president has asked all of the agencies, including the banking agencies, to be thinking about what are their tools to really promote competitive intensity across sectors of the economy. And some of the agencies you mentioned, and I served at one of them, that's really antitrust. That's actually a very different type of thing. The regulators, though, especially the sector regulators, we have a lot of different tools to really promote entry to make sure that there's not lock-in and the control of data, and that is a really big piece of this. We also have a lot of laws that relate to conflicts of interest. And so when do you commingle activities and how that might prove to be a conflict? So in some cases, we may identify issues that maybe we can't solve, but I think we want to be able to make sure that where capital allocators and where new entrants are perceiving barriers, we're looking at it holistically rather than talking to just one firm and figuring out how to help them. That's just wrong.
Well, I think that's absolutely true. Yes, please.
Oops, wow. Sorry. Todd Baker from Columbia's Richmond Center. Thanks again for your commentary. I'm wondering if you can give us a sense of where you think the Bureau is going with the 1033 rulemaking in terms of scope and timing.
Yeah, so I'm going to be, by the end of this year, releasing the first step of the rulemaking outline that will be reviewed by small business entrants. That's part of our process. It's really, a lot of people describe this as an open finance rulemaking. I think that overstates it. It's a lot more about personal financial data rights, the ability for you to get information about yourself, frankly, your transaction history, all of it, and be able to port it or to be able to share it with other prospective offerers. So I will tell you, we are going to make sure that it is not going to be create some underworld for data brokerage scams, but also try our best to help it actually incubate and lower customer acquisition costs. So I expect that first step will happen this year. We will then go through the process to propose a rule. We have to get this one done. It has been sitting around for 12 years or so. Congress put it into action, and we're implementing it. We're also going to be implementing a host of other dormant authorities. I'm starting to use an authority to supervise certain risky non-bank entities that we are going to use a pretty broad and hear complaints and look at growth and look at where there may be risks to go through a supervisory process. We think supervision actually can sometimes be far better than just going down the enforcement route. We can then gain greater insight into how these businesses are evolving. I'm particularly interested in consumer finance infrastructure. So the all of the entities that often we don't choose to do business with but are chosen for us.
And if time permitted, I would ask you about your views on the cloud, but it doesn't. And so
we have 1 minute.
Okay, 1 minute.
Yeah, well, so I have raised in a few fora that we need to be really
because data is being ported to the cloud.
They are, and what I am worried that the financial industry, and I don't just mean the large banks, it's everyone. There's a very small number of cloud providers that they're using, and many of those providers are affiliated with the big tech giants. And the extent to which we have hyper dependence on a set of firms, what does happen when there is an attack or an outage? How do we have assurances as regulators that certain things are going to be turned on? A massive outage at a cloud provider could mean people unable to transact any money. How we figure out what those systemic risks might be, it is part of what I've shared should be something that both the Financial Stability Oversight Council as well as others are taking a hard look at to make sure we have insight into what is going on there.
Well, I think we've had a good view of what muscular regulation is like. And I, for one, am delighted that Rohit took the challenge and is focusing his considerable talents on protecting consumers. Please join me in thanking Rohit.